Solvency is a company's ability to pay its long-term obligations. So liquidity, short-term obligations, solvency, long-term obligations. So whereas this liquidity, we looked at the current asset and current liability section of the balance sheet. For solvency, we're primarily focused on the long-term liability section. But before we do that, let's look at those long-term assets. Remember, the long-term assets, we are using them to help generate revenues and hopefully net income. We are looking at investments or marketable securities that we plan to hold for more than 1 year. For many companies, this is a major component. Notes receivable long-term is a type of long-term investment. Plant, property, and equipment is a major component of investment of long-term assets so that the company can make its products and then sell them to the customers. Intangible assets, they don't have any physical substance to them. A lot of them are legal rights, franchises, licenses, trademarks, patents, but we're also including goodwill in our tangible assets. We might also see lease assets and pension assets on the long-term assets section. We have our total long-term assets and finally our total assets. Long-term liabilities, our solvency is our focus on what is the company's ability to pay off its long-term liabilities. Long-term liabilities, we might see notes payable long-term. These are just the company's loans, typically with the bank, but not necessarily. These are formal contracts. Interest is incurred. Bonds payable. These are $1,000 increments of borrowing from many different buyers of those bonds. Bonds typically have maturities 10, 20, 30 years. Oftentimes, we'll lump these two accounts together and call this long-term debt. And this is going to be for most companies, this is going to be a significant portion of their liabilities, is this long-term debt. We may see lease liabilities if the companies don't outright buy their plant, property, and equipment, but instead lease them. Of course, this is the long-term portion, and then pension obligations, again, of course, the long-term portion. The pension obligations is we've promised our employees that we will pay them when they retire. This is the amount that we owe them. And the pension assets, well, we're not just going to come up with this cash when they all retire. So right for the period of time, we are setting aside some funds in the pension assets so that we can pay out when our employees retire. And this would give us our total liabilities. So two commonly used measures of companies' solvency. One is the debt to equity ratio. It's a little misleading because we see the word debt, and really what we're using is total liabilities. So with this definition, we're equating debt to mean total liabilities. When technically, when we say debt, we typically mean interest-bearing liabilities, so the notes payable and the bonds payable. But we're defining debt to equity, total liabilities divided by total stockholders' equity. Now, this might seem familiar to you when we're comparing liabilities to equity. When we looked at profitability, we had a measure called the equity multiplier. That was our average total assets divided by average stockholders' equity. We really don't need both measures. Our assets are financed by a mix of liabilities and equity. So whether we're comparing those assets to equity or the liabilities to equity, we're going to get different numbers, but they have the same interpretation. They both give us information about how much our assets are financed with equity versus liabilities. Another comment, when we looked at the equity multiplier, we had average total assets and average stockholders' equity. Here we have totals. The reason for that is the equity multiplier was a component of our return on stockholders' equity, which means net income divided by average stockholders' equity. We compare net income for a period of time to equity, which is at a point in time, and we said a period of time income is better to makes more sense to compare the average balance in equity. Here we're comparing two balance sheet amounts, and so there's no real reason to look at averages. We can look at this amount at one moment in time. All right, so how do your liabilities compare to your equity? The higher this debt to equity ratio, the more risk the company has, because remember, this risk is the B word, bankruptcy. What B word were you thinking? So the higher the debt to equity ratio, the greater the risk, and the lower the solvency. Solvency is our ability to pay. The more debt that we have, the more liabilities we have, the harder it's going to be to pay them off. And let's look at the values for our three companies, Walmart, Costco, and Target. Let's look at the debt to equity ratio for each of these three companies. Let's start with Walmart. Walmart's total debt, thanks Walmart, they don't give us the total debt. We can add in 92,415 of current liabilities, add up the long-term debt, long-term operating lease, long-term finance lease, deferred taxes, and if we want to, we can include this redeemable non-controlling interest in order to get the total liabilities. Divide that number by total stockholders' equity, 9349, and we are going to come out to the amount of 1.79. So we say our total liabilities are 1.79 times greater than our stockholders' equity. For Costco, we have total liabilities 43,936 divided by total stockholders' equity of 25058, and that's going to give us a debt to equity ratio of 1.75. And finally, for Target, thanks Target, total current liabilities 19,304 plus the non-current liabilities of 22,620. That's our numerator. And then the denominator 13,432. And that works out to be 3.12. Okay, so we have these numbers here. The question is, which company is the safest? For the safest, we want the lowest debt to equity ratio, and that once again is going to be Costco. At the highest current ratio and the lowest debt to equity ratio. Which company would be considered the least solvent or the riskiest? That would be Target. Its equity is about 3 times greater than its debt. Sorry, its debt is about 3 times greater than its equity. One more typically commonly used measure of solvency is called the times interest earned ratio. This is also called the interest coverage ratio. And times interest earned tells us most of what this formula is. How many times did you earn your interest or your interest expense? So we're going to get that interest expense amount from the income statement and look at income before interest. And because interest expense reduces taxes, we're going to look at net income before interest and taxes. So take that net income number, add back interest expense because we don't want it included, and add back income tax expense. For a simple company with not a lot of non-operating items, this would just be your operating income. But the non-operating items may include things like dividend revenue, impairment losses. So if we want to be more strict, more particular about this, we want to take that income and just add back interest expense and income tax expense. And we were looking at how many times greater is your income without considering interest and taxes? How many times greater is it than your interest expense? How easy is it for your company to cover interest expense? So the higher the number, the greater the solvency and lower the risk. The risk of not being able to cover your interest expense. Of course, looking at that risk of bankruptcy. Let's see what times interest earned is for each of our three companies. Let's start with Walmart. Walmart, the numerator, I need to start with the income statement. And I have net income of $16,270. I'm going to add back to that. So they have a subtotal for the net interest. The net interest, they have interest income. I don't want the interest income. This is what the company earned off of its debt investments. But I see here, this is the interest on the debt and the interest on their finance lease. So I'm going to sum up 2259 plus 424. That's going to be the company's interest expense. So I start with my net income, subtract out these two components for the interest expense, and I also want to back out the income tax expense, 5578. And I'm going to divide that by the interest expense, 2259, divided by 424. And that gets me times interest earned for Walmart, rounded to the nearest whole number, of 9. Pre-interest and pre-tax income is about 9 times greater than interest expense. Looking at that one number alone doesn't tell me a whole lot. I'm going to compare it to the competitors, Costco and Target. Costco, I see interest expense of $160. So I'm going to take my net income, 6292, add back the 160 for interest expense, add the 2195 for income tax expense, and divide it by the 160 for interest expense. Costco has times interest earned of 54. And finally for Target, net income 4138. Now, I don't have my broken down interest expense. This says net interest expense. So if there's any interest revenue, it's the interest expense is being reduced by the interest revenue. I did go into the footnotes, the entire 10K, and try to find what is that specific interest expense, not including in any interest revenue, and I could not find it. So we have to use the net interest expense of 502. We also adjust net income for its income tax expense, divide that by the 502, and I get times interest earned of 12. So the safest company has the highest times interest earned, and that again is Costco.